The wealth foundation. Many people see wealth as the result of individual brilliance, hard work, or a lucky break. We celebrate the entrepreneurs and the innovators, pointing to their creations as the source of their fortunes. While these elements are undoubtedly crucial, they often overshadow a deeper, more fundamental truth. The ability to generate and sustain wealth, on a societal scale, rests on something far more foundational, a system of predictable order. Imagine trying to build a complex structure on shifting sand. No matter how skilled the architect or how dedicated the builders, the edifice will eventually crumble. Wealth operates similarly. Its true foundation isn't just capital or labour, it's the invisible scaffolding of robust institutions. These include secure property rights, which assure individuals that what they own today won't be arbitrarily taken tomorrow. It's the impartial application of law, ensuring contracts are honoured and disputes are resolved fairly. A stable currency protects savings from devaluation, encouraging long-term investment and planning. Without these pillars, economic activity becomes a high-risk gamble, rather than a cumulative process. When these foundational elements are weak or absent, wealth becomes transient, often confined to a select few with power. Entrepreneurs hesitate to invest for the future if their profits can be seized or their business is expropriated on a whim. Innovation stifles when intellectual property offers no reliable protection. Financial markets cannot flourish without widespread trust in their underlying rules and the enforceability of agreements. The stability and predictability these institutions provide are not mere details, they are the bedrock upon which genuine, widespread prosperity can emerge and endure. Understanding how these systems are built, and how easily they can erode, is critical to comprehending the global landscape of wealth. Public equities. When you buy a share of public equity, you are buying a piece of a company. Not a physical asset, but a claim on its future earnings and growth, representing a fractional ownership stake. These companies, from colossal tech firms to essential local utilities, choose to list their shares on organised stock exchanges, making them available for purchase by the general public. This process of going public serves a crucial purpose. It allows companies to raise significant capital from a vast and diverse pool of investors. Anyone, from large institutional funds managing billions to individual investors with a modest brokerage account, can become a part owner. This democratic access is what defines public equity, distinguishing it from private investments. For investors, owning these shares offers two primary avenues for potential return. First, capital appreciation, the hope that the stock price will increase over time as the company grows or becomes more profitable. Second, dividends, which are direct payouts of a portion of the company's profits to its shareholders. The value of these shares, however, is not static. Their prices trade constantly, reflecting the collective wisdom, sentiment, and even speculation of the market. A company's quarterly earnings, its industry's competitive landscape, broader economic trends, and even geopolitical events all weigh heavily on its stock value. Understanding public equity means understanding the pulse of the global economy, recognizing that every price movement reflects a collective judgment about the company's current health and future prospects. It's a dynamic interplay between tangible performance and market perception. But what truly dictates these valuations? And how do investors even begin to assess such an intangible asset in an ever-shifting market? Fixed income bonds. At its core, a bond is a loan. But not just any loan. When you, as an investor, purchase a bond, you're essentially lending money to an entity, often a government or a large corporation. In exchange for your capital, the issuer makes a formal promise. They will pay you a fixed amount of interest at regular intervals, known as coupon payments, for a predetermined period. Then, on a specified maturity date, they will return your original investment, the principal, in full. This predictable stream of interest payments is precisely why these financial instruments are categorized as fixed income. Unlike the fluctuating dividends of stocks or the uncertain capital gains from real estate, bonds offer a clear, scheduled payout. Governments rely on bonds to finance public services, infrastructure projects, or even national debt. Corporations issue them to fund expansion, research, or to manage their cash flow without diluting ownership through stock issuance. For investors, bonds often represent a cornerstone of a diversified portfolio. They typically carry less risk and volatility compared to equity, providing a relative sense of stability. While they generally don't offer the explosive growth potential of stocks, their consistent income stream and capital preservation characteristics make them attractive, particularly in times of market uncertainty or for those nearing retirement. They offer a counterbalance, a steady hand in a world often defined by rapid change. But this fixed nature also presents its own set of challenges, especially when the economic tides begin to turn. Private equity deals. At the heart of private equity's power lies the deal itself. Unlike public market investors who buy shares, private equity firms acquire entire businesses, or at least a controlling stake. This often means taking a company from public to private, or buying a privately held entity outright. The process typically begins with identifying a target company deemed undervalued, inefficient, or ripe for operational improvements. Once a target is chosen, the firm assembles a financing package. This usually involves a significant amount of borrowed money, a strategy known as a leveraged buyout, or LBO. They use the target company's assets as collateral for these loans. This debt magnifies their returns if the investment succeeds, but it also amplifies risk. With the deal closed, the private equity firm takes control. They implement new management, streamline operations, cut costs, or expand into new markets. Their objective is clear: improve the company's financial performance and increase its value within a specific time frame, often 3 to 7 years. The ultimate goal is an exit strategy. This could mean selling the improved company to another private equity firm, to a strategic buyer, or taking it public again through an initial public offering. These deals reshape industries, create wealth, and sometimes spark controversy, all while fundamentally altering the trajectory of the acquired business. The sheer scale and complexity of these transactions hide an often brutal efficiency, continuously moving capital in search of greater returns. Venture capital funding. Every truly disruptive idea, every technology poised to reshape an industry, eventually hits a critical juncture: the need for significant capital to scale. Traditional lenders, like banks, often see these nascent, unproven ventures as too risky, demanding collateral or a stable revenue history that simply doesn't exist yet. This is precisely the void that venture capital fills. Unlike a loan, venture capitalists don't lend money, they invest directly. A VC firm will provide funding in exchange for an equity stake, a percentage of ownership in the startup. These funds typically come from institutional investors, like pension funds or university endowments, pulled together and managed by experienced venture capitalists. They're betting on explosive growth, not just incremental returns. Their investment isn't just cash, however. VCs often bring invaluable strategic guidance, a vast network of contacts, and operational expertise, effectively becoming deeply involved partners in the company's journey. The ultimate goal for a venture capitalist is a profitable exit, usually when the startup is acquired by a larger company or goes public through an initial public offering. At this point, the VC can sell their shares, ideally for a massive return on their initial investment. This model is inherently high risk. Most startups they fund will fail, but the few that succeed can generate returns that cover many losses, transforming innovative concepts into global enterprises. It's a powerful engine, selectively fueling the future's most ambitious innovations. Real estate portfolios. A real estate portfolio represents more than just a collection of properties. It's a strategically assembled basket of assets designed to generate wealth. These assets can range from single-family homes and multi-unit apartment buildings to sprawling commercial office spaces, industrial warehouses, or even specialized properties like hotels and data centers. The goal for many investors is multifaceted: to secure a steady stream of rental income, benefit from long-term capital appreciation as property values rise, and often, to diversify their overall investment holdings, reducing risk by spreading it across different asset classes. Building such a portfolio requires careful consideration of numerous variables. Investors must weigh factors like property type, geographic location, and the current economic climate, understanding how each influences potential returns and risks. A truly robust portfolio often includes properties in different cities or even different countries, each serving a unique purpose within the larger strategy, buffering against localized downturns. Some investors prefer an active role, directly acquiring properties, managing tenants, and overseeing maintenance schedules. This hands-on approach offers greater control but demands significant time and expertise. Others opt for a more passive method, investing in real estate investment trusts, known as REIT, which are companies that own and operate income-producing real estate, offering liquidity without direct management responsibilities. Ultimately, a real estate portfolio is a dynamic entity. Its performance hinges on market demand, interest rate fluctuations, and broader economic trends, making continuous evaluation and adaptation a critical component for its long-term viability and growth in an ever-shifting landscape. Hedge Fund Strategies. Hedge funds aim for absolute returns, seeking profit no matter the market's direction. They use a diverse set of sophisticated strategies to achieve this. The long/short equity strategy is a core approach. Managers buy stocks they expect to rise long and simultaneously bet against others they expect to fall short. They profit from the relative performance of these chosen companies. For instance, a fund buys a promising tech firm while shorting a struggling competitor, aiming to buy back those shorted shares cheaper. This minimizes overall market risk, emphasizing stock selection skill. Event-driven investing capitalizes on specific corporate actions. Mergers, acquisitions, bankruptcies, or spin-offs, for example. A fund might buy shares of a target company and announce takeover, expecting its price to rise to the offer. Or they might buy distressed debt, anticipating a profitable restructuring. These strategies rely on deep corporate finance and legal analysis. Global macro takes a much broader view. Managers forecast major economic trends, interest rate shifts, currency movements, or political changes across countries or regions. They place large bets using derivatives like futures and options across multiple asset classes. This flexible approach profits from vast macroeconomic shifts, valuing the global financial landscape over individual company performance. Each strategy carries unique risks and requires specialized expertise, revealing the diverse and complex world of hedge fund operations. Art and Collectibles: what transforms a simple object into a prized possession? For centuries, art and collectibles have occupied a unique space, transcending the material form to embody cultural significance, historical narrative, or pure aesthetic appeal. Consider a painting. Initially, it's pigment on canvas, but once a master's hand applies that pigment, once it survives generations, its identity shifts. It becomes an artifact, a window into another time, a piece of someone's legacy. The market for these items operates on a fascinating blend of objective metrics and profound subjectivity. Authenticity, proven as the documented history of ownership and condition, establish a baseline. A clear chain of custody for a renowned artist or a significant historical event adds tangible layers of value. Yet, the price often surges far beyond these factors, driven by desirability, by current trends, or by the sheer emotional connection of a buyer. This is where the collector's impulse comes into play. It's more than just acquisition, it is about curation, about owning a piece of history, an echo of genius. Whether it's a rare first edition book, a vintage timepiece, or a contemporary sculpture, the thrill lies in the chase, the discovery, and the possession of something deemed exceptional. Scarcity naturally amplifies this. When supply is limited and demand is high, value inevitably climbs. This intricate ecosystem of art and collectibles doesn't just preserve culture, it actively shapes perceptions of worth, challenging us to define what truly holds value in a world of ever-shifting tastes and technologies. It asks, what will endure, and what will become tomorrow's treasure? Alternative assets. For generations, the default investment portfolio relied on a simple formula: stocks, bonds, and cash. These pillars formed the foundation of financial security. But today, investors increasingly explore options far beyond this traditional trinity, venturing into what's broadly termed alternative assets. These investments diverge sharply from publicly traded securities. Think private equity and venture capital, funding companies before they hit public markets. Consider tangible assets, real estate, rare art, fine wine, classic automobiles, or commodities like gold. Even newer digital assets, such as NFTs, fit this evolving category. What draws capital to these less conventional avenues? Diversification is a primary appeal. Alternative assets often show little correlation with traditional markets, offering a potential buffer during downturns. They can also provide distinct return profiles, sometimes higher, though usually at the cost of greater risk and reduced liquidity. While once reserved for institutions, new platforms are now democratizing access, allowing fractional ownership in assets from luxury watches to commercial real estate. Yet, this expanding universe presents its own challenges. Valuing these assets can be complex and subjective, unlike the clear-cut prices of public stocks. Selling them often takes time and effort, contrasting with instantaneous trades. Understanding unique risks, tax implications, and time commitments for each becomes paramount. As the investment landscape evolves, the question isn't asterisk if asterisk to explore alternatives, but asterisk how asterisk to thoughtfully integrate these diverse, often illiquid opportunities into an overall financial strategy. Family office management. For families whose wealth spans generations, managing assets extends far beyond simple investment decisions. The sheer scale and complexity demand a dedicated, centralized approach. The family office. This private entity acts as a personal chief financial officer, but with a scope that encompasses every facet of a family's financial and sometimes personal life. This dedicated team handles everything from intricate investment strategies and meticulous tax planning to estate structuring, risk management, and philanthropic initiatives. They often oversee legal matters, manage art collections, or even coordinate the education of younger family members. The objective is not merely growth, but the preservation and efficient transfer of capital, ensuring it endures and continues to benefit successive generations. Unlike traditional wealth managers, a family office offers unparalleled discretion and a highly integrated service model, treating the family assets as a long-term enterprise. It means crafting bespoke solutions that align with the family's unique values and multi-generational vision. Building such an infrastructure requires a deep bench of experts capable of navigating global markets, evolving regulatory landscapes, and the diverse needs of multiple family members. It is a sophisticated operation designed to transform substantial wealth into sustainable, ensuring its power and purpose persist through time, rather than diminishing with each passing generation. Impact investing. For decades, the world of finance largely operated on a singular principle: maximizing returns. Investors sought profit, while social or environmental concerns often fell to the realm of philanthropy or government. But a powerful shift is underway, blurring these lines. This is the rise of impact investing. Unlike traditional investing, where financial gain is the sole driver, impact investing intentionally seeks to generate a measurable, beneficial social or environmental impact alongside a financial return. It's not simply about screening out bad companies. Like some ESG strategies, it's about actively investing asterisk into asterisk solutions. Think capital directed towards renewable energy projects that cut carbon emissions, or companies developing sustainable agriculture practices to improve food security. It includes funds building affordable housing, or microfinance institutions empowering entrepreneurs in underserved communities. The defining characteristic of impact investing is this dual objective, proving both a positive societal contribution and a competitive financial return. It demands rigorous tracking and reporting, demonstrating tangible changes like tons of carbon offset, liters of clean water provided, or jobs created. This approach challenges the long-held belief that doing good must come at the expense of profit. Instead, it posits that some of the most critical global challenges also present significant market opportunities. As more investors, from large institutions to individuals, seek to align their capital with their values, the very definition of a successful investment continues to evolve. Strategic philanthropy. For generations, philanthropy often meant responding to immediate needs, donating to food banks, supporting disaster relief, or funding a local hospital wing. This traditional generosity provides vital support, reacting to crises as they emerge. But a more deliberate and proactive model has steadily gained prominence: strategic philanthropy. This approach moves beyond simply writing a check. It applies the rigor and long-term vision typically found in business to charitable giving. Imagine a donor not just as a benefactor, but as an investor seeking returns, though these returns are measured in social impact, not profit. Strategic philanthropists identify pressing social issues, perhaps chronic educational underperformance in a specific region, or systemic health disparities. Instead of funding individual school supplies or offering temporary clinics, they might invest in comprehensive teacher training programs, curriculum development, or sustainable health infrastructure, always with clear, measurable outcomes defined upfront. The shift is profound. This model aims to address root causes, not just symptoms. Donors develop explicit objectives, build robust partnerships with organizations possessing deep expertise, and rigorously track progress using data. This means understanding exactly what tangible impact their dollars create, rather than just how many dollars they spent. It demands patience, a willingness to innovate, and an acute focus on long-term, sustainable change. This perspective transforms giving from a simple act of kindness into a powerful, data-driven engine for systemic transformation, compelling us to reconsider how we approach some of the world's most complex problems.